Max Keiser of the Keiser Report on RT, and of course the On the Edge on Press TV, and radio host, you name it, joins us via video Skype from Paris. And I wanted to get him on because we've got these reports here. Bernanke promises no new steps to boost economy. Bernanke proposes no new steps to boost economy, but hence Congress should help with a new stimulus, I guess, given the special interest. But according to Dr. Roberts and others we've talked to, they're still really engaged in QE3 by stealth, still having the private Federal Reserve buy the Treasury bonds. Max Keiser, what's really happening here?
Well, first of all, can you hear me? I have my headphones in. Can you hear me?
Yes, sir. Okay? I can hear you. Very nice headphones.
Okay. Well, one of the interesting points that he made was that he was going to extend next month's Federal Open Market Committee for 2 days, and they're going to introduce and talk about special tools or new tools to keep quantitative easing going. And the fact that he's not introducing quantitative easing 3, as you point out, the market is still not suffering in terms of where the bond prices are. Bond prices are still being held up. So clearly somebody's doing the buying, and that somebody is the federal government. And so I think what they're doing is they're waiting to back end some big surprises in next month's meeting, which would be the September Federal Open Market Committee meeting. But this is some of the tools that they could be used. I think we're seeing what's happening in countries like Switzerland, which is now charging people to keep money in banks in Switzerland. That's a negative interest rate. And I think this is part of the toolbox that they're going to introduce. So when you have $100,000 at the bank, or even $10,000 or $1,000 at the bank, they'll charge you 1 or 2% as a cost. Remember, only a couple of years ago, you might get 1 or 2% in interest. Now they'll charge you 1 or 2% to store your money. The theory being that this will encourage people to take their money out of the bank and spend it on stocks or spend it on consumer items to get the economy going. And that's one of the so-called special tools that I think we're going to see next month.
Now, in your email this morning, when we contacted you and asked you to come on, you fired back with basically saying banks are getting ready to melt down all over the world, and you listed some countries, mainly in Europe, and then you said 1, 2, 3 meltdown. So I guess this little segment could be called 1, 2, 3 meltdown, Max. What does 1, 2, 3 meltdown mean?
Okay, well, starting in and then, of course, 2008, we had the collapse of Lehman Brothers and Bear Stearns, and everyone became aware of this global financial crisis. We've been playing a global game of pass the grenade, and the grenade is $50 trillion in debt. And various countries are playing this game of pass the grenade. And if you look at the Financial Times, you'll see this being played out every single day. So in Greece, they announced that Finland is not happy with the collateral that they're getting in exchange for debt forgiveness in that country. So now the ECB is coming in to guarantee more backstop on the Greek economy collapsing. So they're trying to pass the grenade. In France, as I spoke to you on the last time I was on your show, Societe Generale, major bank here in France, technically insolvent, the biggest player and the biggest bailout recipient after the AIG collapse in 2008. They're on a tinderbox. They are in the process of needing some major bailout. They're about to go belly up. And, of course, Bank of America here in the United States. A week ago, they said, we don't need capital. But then Warren Buffett said, well, I know you don't need capital, but here's $5 billion anyway. And by the way, I'm going to charge you 7% on that money, even though you could get it, same deal from the Feds for 0.25%. And you also, they're selling their big stake in China Construction Bank today to raise capital as desperately as they possibly can, because Bank of America, the second biggest bank in America, is insolvent. So is Societe Generale. So are the banks in Greece. So this game of global pass the financial grenade is speeding up. The stakes are getting higher. And we see it happening in live now in real time with news coming out. And as a result, Alex, the markets themselves, you see these enormous swings in volatility. The stock market up and down 400 or 500 points. Price of gold up and down 2 or 3 percentage points in a day, because the markets themselves are reflecting this unfolding chaos, this unfolding meltdown, banking meltdown. And Bernanke, of course, without being able to offer any leadership whatsoever. He's simply kicking the can down the road and saying, well, next month we'll get to it with special tools that we'll pull out of our magic bag of tricks next month. In the meantime, we're just going to continue to buy these debts in the shadow banking system. We're going to increase the debts in the U.S., which is only making the situation much, much worse.
That's right. So when the chickens do fully come home to roost, it'll be much, much worse, as Ron Paul and many other people have broken down. And you call it pass the grenade or musical chairs. And the person that gets left standing when the music stops basically burst into flame. You could also liken it to a revolver with, say, 15 chambers in it, and there's a round in one of them. And so they spin the cylinder, and they hand it to Europe, then back to the U.S., and then to England, and then they hand it to Asia, and then they hand it to Latin America. So they're trying to pass the grenade around, but even as they're passing it around, Max, we see the blood running out of the economy worldwide. So I go back to this. As we get closer and closer to this event horizon that Dr. Roberts was talking about yesterday, where there is no point of return, he believes there is a point of return if they reverse these policies. But they're not reversing them because it's command destruction. They are wrecking the global economy, massing all the assets in their hands. Then they'll blow out the dummy banks later. The elites will be left holding all the, quote, resources, and then we'll be their debt slaves. So what's the time frame here, Max, on how you see all of this basically playing out?
Well, what's being sacrificed in the interim, what's being sacrificed today are various countries' sovereignty. So in the case of Greece, they've lost their sovereignty. In the case of Ireland, they've lost their sovereignty. Iceland maintained their sovereignty only by kicking the bankers out and prosecuting them and chasing them into London, where they're hiding out, and by letting their economy collapse. But they're the exception. So, these countries are in turn losing their sovereignty. And the way that it happens is that because there's no leadership from a Bernanke or an Obama, they keep deferring to the Bank of International Settlements or the World Bank or the International Monetary Fund, which of course are global institutions. So Bernanke and Obama are swapping America's sovereignty to avoid having to deal with this problem today. And that's happening right now. So the timeline is today. America is in the process of losing its sovereignty today because the financial decisions that will affect America's future are being discussed in the hallways and the conference rooms in Brussels, in Switzerland, in Europe, and around the world. They're not being discussed by Obama. Obama has essentially abdicated his role as president of the United States. He's now just a functionary waiting for instructions from these global bankers who have taken on the responsibility to sort out this debt problem. And the way that they sort out the debt problem is to increase the debt. And that's the only thing they know how to do. And as a result, it's only making the situation much worse. Now, just as a way to illustrate this, Alex, I thought this might be interesting. As I was waiting to get on the show here, I posted on my website 2 charts. The U.S. government 10-year bond chart, both the price and the yield, to just give you a graphic illustration of the history of America's demise. Because if you go back to 1980, when the 10-year interest rate was 15.5%, that was the beginning of the Reagan Revolution and the neoliberal revolution and the Wall Street ascent to take over the economy. Since that 1980 period, when interest rates on the 10-year bond were 15.5%, they are now at 2%. And that is the history of America going into the debt market to finance its growth. At some point during the past 40 years, somebody should have stepped in and stopped that 10-year interest rate from going to 2%. Because 2% is like, if you have to think of it like an EKG machine at the hospital, you know, when it gets down to the point where it's not moving anymore, the patient is dead.
Max, let me stop you. We're going to, for PrisonPlanet.tv viewers, radio listeners can go to MaxKeiser.com and see these graphs. But for live viewers right now that are watching us on TV, we're going to put the graphs up on screen. So describe what you're talking about here.
Right. This is just a very simple graph of the price of a U.S. government 10-year Treasury bond going back to 1980, when the yield or the amount of money you would get on that bond, if you were a saver and you bought a 10-year Treasury bond, you would be getting 15.5% on your money. If you're a saver, if you had a pension account, that's what you got on your money. And as you see, the history up until today is the slide down to 2%. And last week it got down to below 2%. Underneath that chart, you see the price of the bond markets that have gone up and up and up. Now, the reason why it's important to understand this is when people talk about extend and pretend in dealing with the debt problems, what they mean is that as long as interest rates are going down, as you see in the top chart, they can keep adding to the debt load and making it the debt load bigger and bigger because the interest cost on that debt, as you see that in chart number 1, they keeps getting cheaper and cheaper. And at the bottom, you see the price of the bonds getting higher and higher. And that's the dynamic. That is the essential underlying dynamic driving 40 years of financial history in America and how America went from having $500 billion of debt under Reagan to having 14 to 15 to 16 trillion in debt with another 50 trillion off the books. That's how they did it. They used artificially cheap interest rates, and that's what quantitative easing is, Alex. It's about the government keeping interest rates artificially cheap to support this bond market, and that's the dynamic.
Absolutely. When we come back, I want to get to the central issue. It's horrible for us, but it's good for the central banks. They institute the crisis. They pose as the saviors. They take the system completely over and then rape us that much harder. How do we get out of it? Ask yourselves, what are you doing in this time of great challenge? What are you doing to unlock minds?